Something massive is happening in global finance, and most people are only seeing the surface-level headlines. BlackRock, $2 trillion, a quiet move that barely made noise outside financial circles. But when the world's largest asset manager shifts capital at this scale, it's never just routine portfolio management. It's a signal. And signals like this usually appear right before the rules of the game change. BlackRock doesn't trade like retail investors. It doesn't chase hype or headlines. It positions early, slowly, and with purpose. When it reallocates trillions across asset classes, regions, or structures, it's not reacting to the future. It's preparing for it. That's why so many people are calling this moment the beginning of a great wealth transfer. Not because wealth is suddenly disappearing, but because it's quietly moving from one place to another. To understand why this matters, you have to understand what BlackRock really is. It's not just a company, it's infrastructure. BlackRock manages money for governments, pensions, insurance companies, sovereign wealth funds, and institutions that can't afford to be wrong. Its algorithms, models, and risk frameworks shape how capital flows across the entire planet. When BlackRock changes direction, markets feel it whether they realize it or not. The phrase, $2 trillion move, doesn't mean BlackRock dumped cash into one single investment overnight. It refers to a broad reallocation across strategies that signal a deeper shift, away from certain assets, toward others, from liquidity to control, from growth at any cost to hard cash flow, real assets, and structural advantage. And that's where the wealth transfer begins. For years, the global economy was fueled by cheap money. Low interest rates inflated stocks, real estate, crypto, startups, and speculative assets. Anyone holding risk did well. Wealth grew fast, but unevenly. Those closest to capital benefited most. Now that era is ending. Rates are higher, liquidity is tighter, debt is expensive. Governments are struggling to finance deficits. Consumers are stretched, and markets are becoming less forgiving. In environments like this, wealth doesn't evaporate. It consolidates. Institutions with scale, patience, and access step in where smaller players are forced out. BlackRock's moves reflect this reality. More capital flowing into private credit, infrastructure, energy systems, data centers, logistics, and essential services. Less exposure to assets that depend on endless growth and cheap borrowing. More focus on things people can't stop using even during downturns. This is not a bet on collapse. It's a bet on stress. And stress creates transfers. When interest rates rise, debt-heavy players suffer. Homeowners with variable loans. Small businesses relying on cheap credit. Governments rolling over debt at higher costs. At the same time, those who lend instead of borrow gain leverage. Private credit funds step in where banks pull back. They offer financing at higher rates, stricter terms, and better collateral. BlackRock has been positioning aggressively in this space. That's not an accident. Private credit has become one of the fastest-growing segments in finance because it thrives when traditional systems tighten. It allows large asset managers to effectively replace banks, collecting yield while controlling risk. For borrowers, it's often the only option left. For lenders, it's power. This is how wealth shifts upward during tightening cycles. Another area drawing massive institutional interest is infrastructure. Roads, ports, power grids, renewable energy, water systems, and digital infrastructure. These assets generate predictable cash flow, are often backed by governments, and are resistant to inflation. When everything else feels unstable, infrastructure becomes a financial anchor. BlackRock has been expanding here aggressively. Why? Because governments are broke, but infrastructure still has to be built. That means public-private partnerships, long-term concessions, and asset sales. Control moves from the public sector to private capital, slowly but legally. Ownership changes hands. Revenue streams follow. That's another form of wealth transfer. Then there's real estate, but not the kind most people think of. Not luxury condos or speculative flips. Industrial warehouses, data centers, rental housing, logistics hubs, properties tied to supply chains and digital economies. These assets benefit from long-term demand and limited supply. As higher rates price individuals out of ownership, institutional landlords gain scale. Renting becomes permanent for more people. Cash flow becomes king. Again, this isn't conspiracy, it's math. Higher rates change behavior. Those changes create opportunity for those positioned to absorb them. BlackRock's $2 trillion shift reflects this math. There's also the geopolitical layer. Capital is becoming more selective about where it goes. Political stability, rule of law, energy security, and demographic trends matter more than ever. Money is flowing toward regions seen as resilient, and away from those facing structural decline or policy uncertainty. This reallocation reshapes global power, one investment at a time. And here's the uncomfortable part. Retail investors usually react late. They feel the pressure first, then see the narrative later. Rising costs, falling purchasing power, fewer opportunities. Meanwhile, institutions are already positioned to collect yield, fees, and ownership. That's why people call it a wealth transfer. Not because someone flipped a switch, but because the system rewards scale during stress. BlackRock isn't causing this shift. It's exploiting it. And if they weren't, someone else would. The question most people should be asking isn't, is this fair? It's, what does this mean for me? Because ignoring these signals doesn't protect you from them. During past cycles, wealth transfers followed similar patterns. The Great Depression, post-war industrialization, the inflationary 1970s, the dot-com bust, the 2008 financial crisis. Each time, capital moved from weak hands to strong ones, from over-leveraged to liquid, from speculative to essential. This cycle is no different. It just looks quieter. Algorithms replace traders. Balance sheets replace headlines. Long-term contracts replace short-term gains. BlackRock's scale allows it to see across markets in ways few can. Pension flows, demographic data, government financing needs, corporate refinancing schedules. When they shift trillions, it reflects probabilities, not predictions. They're not betting on disaster. They're betting on friction. And friction always creates winners and losers. The dangerous mistake is assuming this only affects billionaires and hedge funds. It doesn't. It shapes job markets, housing affordability, energy costs, retirement returns, and access to credit. When capital concentrates, flexibility disappears for everyone else. That's why understanding these moves matters. You don't need $2 trillion to learn from what $2 trillion is doing. The takeaway isn't panic, it's awareness. We are moving into a world where money is more expensive, risk is repriced, and ownership matters more than growth narratives. Institutions are positioning for control, cash flow, and durability. Individuals who ignore this shift may find themselves permanently reacting instead of adapting. The great wealth transfer isn't a single event. It's a process unfolding in slow motion. And BlackRock's move is one of the clearest signals yet that the old rules no longer apply. The question now is simple. Will you notice it early enough to adjust, or only feel it after the system has already moved on? Because by the time everyone agrees what's happening, the transfer is usually complete.